We're going to answer the question this morning, why is Donald Trump bad for stock markets? Good morning everyone and welcome back to Morning Markets here at True Potential. Over the weekend, Donald Trump tried to describe his economic inheritance as a mess. To clarify, when he took office, GDP growth was around 3%, unemployment was near 4%, a record number of Americans were in work, real wage growth was 2%, and of course inflation in the last month of President Biden's term had declined to 2.6%. So a little above target, but certainly close enough that the Federal Reserve were able to cut interest rates in the last quarter of last year. Fast forward to today, stock markets are not reacting well to the continuing noise from the White House. The S&P 500 is down almost 10% since its peak only 5 or 6 weeks ago. And this is before we take into account any revisions down in US earnings growth. Currently, corporate America is expected to have profitability growth of 10% this year and even more next year. However, updates from Delta Airlines overnight are a canary in the coal mine. Delta Airlines have slashed their earnings guidance for this quarter by half. Only 9 weeks ago, their CEO described the beginning of 2025 as a record and that the company expected to post record profits for 2025. Now they've had to slash their earnings per share growth from around about 80 cents to 40 cents. And they're highlighting macro uncertainty and economic doom. This is a rather benign way of trying to say that policy from the White House is now impacting Main Street. Households are rowing back in their spending intentions, worried about their future economic prospects. None of this was in the winds of change at the start of the year, and it's all to do with President Trump spreading doubts amongst American investors and people on Main Street that there is a material slowdown ahead. And that's simply to do with the expected inflationary impulse from tariffs if they do go ahead. Let's remind ourselves that Trump pulled back on those tariffs again for Mexico and Canada, but also on the expected public spending cuts coming from Elon Musk as he works his way through government departments. And all of this is feeding itself into surveys from businesses and households that they're now quite negative on the outlook for the rest of the year. Now, of course, we do have tax cuts coming towards the end of the year if both houses of Congress can get their act together. However, we are seeing signs of a slowdown simply because of the policy in the US. And we're also seeing bond yields fall. So thankfully, bond yields are acting as a negative diversifier as equity prices fall. Bonds are actually adding positive value to portfolios, unlike in 2022 when both the price of bonds and the price of equities fell. And in fact, the returns from US sovereign bonds, US Treasuries, has actually been above 2% year to date, even as equities have fallen. So that negative correlation, that diversification effect has come through in portfolios. So we're in a period right now where data may not matter for investors as and until the noise from the White House calms down. We get US inflation data this week, and we saw a fairly decent jobs print last week. However, markets are more focused on the White House than what data is coming out from the economy. Please join us tomorrow where we'll give you more reflections on movements on equity prices and in the bond market. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.